The Australian Financial Review.
Okay, our first guest has great news for the professional stock pickers in the audience. As you heard, the Chief Executive of the Future Fund is here to declare active is back.
Raphael Arndt came to the Australian Financial Review's Alpha Live conference armed with a crowd-pleasing announcement. The country's sovereign wealth fund was once again hiring active fund managers to invest its money.
And he's got $65 billion in equities, so don't be shy to hit him up for a piece of that later. Please welcome Dr. Raphael Arndt.
6 years ago, the Future Fund had effectively turned its back on active fund managers, taking the view they were unlikely to beat the market. Central banks were cutting interest rates, and in the age of cheap money, the case for passive investing was compelling. The rising monetary tide lifted all boats. But Arndt told Companies editor Vesna Poljak on the stage that day, the world has changed. It's much more volatile.
After decades of a benign geopolitical environment, today war has returned to Europe, and countries in our region are spending more on defence than they have in decades. The world is deglobalising, tariffs and trade barriers are re-emerging.
And in uncertain times, active fund managers, many of who were in the audience, were worth the extra fees.
Economies are diverging. Companies can better distinguish themselves in this more challenging environment, and as a result, active alpha-seeking strategies are increasingly attractive, provided that we can be confident that returns are driven by skill and not luck.
Welcome to The Fin. I'm Lisa Murray. Today, Companies editor Vesna Poljak and senior reporter Jonathan Shapiro on the reasons behind the Future Fund's about-face and why its decision was a jolt to the investment industry. And later in the episode, senior correspondent Jacob Greber will give us his take on this week's federal budget. It's Thursday, May 11. Thanks both for being here. Before we go into the Future Fund's about-face, Johnny, explain exactly what the Future Fund is and why it was set up in the first place.
Well, Lisa, the Future Fund was the brainchild of the former Treasurer Peter Costello. And Costello could see out into the future that there were a whole lot of very large government liabilities. And he had the view that while the budget was in surplus and the government had extra cash and it was going to have a bit of a windfall from privatisation of Telstra, that he should take a chunk of money and invest it to try and create a growing pool of assets to offset those liabilities, including public service pensions that were going to cost the government a lot of money. So in about the mid-2000s, there was about $60 billion of money that went in to create the Future Fund, and the objective was to earn a rate of about 4.5% above the inflation rate through investing without taking undue risk. And that was effectively the creation of the Future Fund. It's often confused as a sort of government super fund, but it's not like that at all. It's actually taxpayer funds that are being invested by a division of the government to try and offset the liabilities that we're all on the hook for.
And how much funds under management does it have now?
It's grown from 60 billion in about 2006-07 to just over 200 billion.
So 6 years ago, when Arndt was Chief Investment Officer, in a blow to the industry, the Future Fund took the dramatic step of firing its active fund managers. Arndt said at the time that they had been given a free kick in recent years because of the rise in asset values, but this era was ending and lower returns made the high fees hard to justify. Johnny, that move by the Future Fund fired up the debate about active versus passive investing. Tell us about the origins of that debate.
Now, the active versus passive debate is probably the most fiercely drawn battle line in investment markets. Now, the case for passive is very compelling. A lot of fund managers have failed to beat the market and therefore don't justify their fees. But on the other side, trying to contemplate a world without active managers, without people holding management to account or selling things that they think are bad and buying things they think are good, and talking and engaging with the market is also a world that's very difficult to contemplate. So the origins of this debate go back to the 60s when a gentleman named Jack Bogle created a company called Vanguard, and Vanguard created the first index fund.
Do you still expect, Mr. Bogle, that if this becomes what people call a stock pickers market, that the index funds will continue to outperform the stock pickers?
I don't think there's such a thing as a stock pickers market, Tyler. All investors are picking all stocks, and to the extent an index fund owns all stocks, it's a sort of contradiction in terms.
Now, an index fund simply bought the stocks that comprised of the market, weighted by their market capitalization. So the biggest companies were the biggest part of the index.
So it's been a revolution, indexing has, and it's changed the nature of how people look at investing.
And when he created that index fund, he got very little take-up. There was very little excitement about it. No one was interested.
It took 20 years until the mid 90s,
right,
for it to begin to gain real traction, and then it accelerated, and the growth from 1995 to 2016 has been astonishing, and it's sustained.
But over the years, as more people began to appreciate how difficult it was to beat the market, more capital started to flow into passive funds. And by maybe the 2010s, passive investing became an enormous industry with trillions of dollars of capital simply accepting or determining that it's best to simply invest in the market in a holistic sense rather than paying stock pickers to try to beat the market. And beating the market is extremely difficult. Now, SPIVA, which is a unit run by Standard & Poor's, are the self-proclaimed referees of the active versus passive debate. And right now, the scorecard is still very much in favour of passive funds. Now, 80% of active fund managers have underperformed the index over 5, 10 and 15-year periods.
So, Vez, there's this move towards passive investing that Johnny's talking about, but not everyone was putting their money in passive funds. There were still fund managers out there every day trying to beat the market. The Financial Review singles those managers out every week in our Monday Fundy column, and that column reaches an important milestone this year. Tell us about that and how it has tracked the funds management industry over the past decade.
So the Monday Fundy column, it's having its 10th anniversary this year. And as Johnny said, it's very hard to beat the market. And those that do can't do it all the time. Not all fund managers are capable of it because not only do you have to be, a little bit of a contrarian or, at least willing to go against the herd and feel stupid for some period of time, you have to probably be a little bit lucky too.
And so every week you've been talking to different fund managers about their fund management style. What have you picked up over that time?
So it's always interesting to ask people what makes a good business. And you would think you get the same answer every time, but no, not at all. It comes back to their style. Are they a value person? Are they just looking for something that's worth $1 trading at 70 cents? Or are they a growth person? But then again, you never know when you're interviewing someone what they're really like, so the challenge is to try and elicit some of that. A good way to convey to the reader is to talk a little bit about their process and how they go beyond that. So I recall one interview we did with Andrew Brown. He was researching a company that used to be known as CabCharge, and he went and drove an Uber in his spare time for 3 months. Mm-hmm. Rob Arnott, who is from Rafi, he came to Australia and he was adamant that the best thing you can do is watch financial TV for 3 months and just do the opposite. Mm-hmm. The point of that is there's this thinking, don't chase performance. So if something's a winner, don't go and back the winner. There's a lot of thinking and research behind all of these things, and sometimes they're true, sometimes it's true, sometimes it's not.
So, Vez, you've been tracking the funds management industry for the past decade, and as you said, there's a bit of science to it, but it's also about the personalities. And then a couple of weeks ago, you interviewed Future Fund CEO Raphael Arndt at the Financial Review's Alpha Live event when he made his big announcement. Set the scene for us. Tell us what he had to say and how it was received in the room.
So we had about 150 people there. And the idea was, we're not here to sort of tell you what to do. We're just here to sort of celebrate the best ideas. So Raf Arndt starts the day and there's a real buzz, you can detect that.
We're experiencing some of the most profound changes in living memory, and to succeed as investors, we all need to change how we think.
He got up and he said that the Future Fund was once again standing behind active managers and would support them by awarding mandates.
We're doing everything we can to find skill wherever it exists, but it's rare and expensive, and sometimes paying high fees to fund managers is necessary to access that skill.
Meaning he'll write a cheque for a couple of $1 billion. And there's a fund manager out there who will get that, and suddenly, they're backed by the Future Fund. That's a huge deal.
But Vez, why is the Future Fund doing this now?
The Future Fund is doing this now because market conditions have been so distorted by central banks for so long now. I mean, they've been out of active for 6 years, but this goes beyond that. And we'd got to a point, the world had arrived back at this place that was somewhat close to, once again, rewarding companies for doing good things and penalising companies for doing bad things. And if your job is to buy stocks and sell stocks, then you can do well, once again. Like, your opinion matters. Suddenly we have almost a healthy market. I mean, it's hard, right? It's still hard, but things make a lot more sense now. So, that being true, they're willing to, and as he said, pay for the best fund managers. They're not just going out there trying to screw them on fees, which is the story we've heard for a long time. They just want the absolute best at their job, and they will give them money, and they have a lot of money to go around.
So, Johnny, the Future Fund has changed course, and as Vez was just explaining, it's now backing active funds management because we're in a more volatile world. What does Raphael Arndt mean when he talks about volatility?
Lisa, what the Future Fund's view is, and I think it's shared by a lot of asset managers, is we're in a world that is far more unpredictable. So we had a good demonstration as to how uncertain and unpredictable this world is when the Reserve Bank surprised most people, certainly surprised the market, because there was a next to zero chance that priced in by the market that the Reserve Bank would move interest rates, but it did, and that created quite a volatile day on share markets. So that certainly demonstrates the world we're living in, where there's more unpredictability. And up until COVID, and even post-COVID to some degree, there was order. Markets moved in tandem. Interest rates moved in tandem, currencies were relatively stable. There was far less dispersion in equity markets across the world, and bond yields as well, and bond markets too. There was some sort of consistent relationship, but that's all completely changing now. So some economies are going to perform way better than others. Some central banks will be raising interest rates while others are cutting interest rates. Some companies in the same sector will have too much debt and be in real trouble, while others will be debt-free and potentially thrive and take over their competitors. Some commodities will do well, others won't. So there's far more opportunity for dispersion than there's ever been because we're sort of coming out of this post-COVID period where there's high inflation, more geopolitical tension, and more divergence. So this is a world where the Future Fund believe that luck isn't going to mask a bad investment decision, and skill will be rewarded. So they will obviously apply a very sophisticated lens over fund managers to see who has true skill, and they'll allocate their money in the expectation that this environment will reward them.
Mm-hmm. So, Vez, we've got these differing market views about the economic outlook, got the uncertain global economic situation and geopolitical situation. How is it exactly that active fund managers can thrive in this sort of environment?
So the skilled ones will do well, but you also have to have the right style and discipline for the times. So part of the thinking is that as the bubble in everything deflates, the market becomes more discerning in deciding where to allocate capital, how to reward good businesses and punish bad businesses. What that means for a fund manager is you can exercise judgment and be right or wrong, not because the central banks are pumping money out and everything is going up, even the bad stuff. It means that what goes up happens for a reason, and it takes shrewd thinking to identify that reason. And if you can correctly identify what's going up before it happens, you make money. That's alpha. That's all that is. And it's not the future fund's job to go out and find these businesses. The fund managers do that, and the future fund hires them.
And one thing to add is the cost of money's gone up. So, in the US, interest rates are at 5%, and here, interest rates are at 4%. So, what to do with your money has far more significant consequences. The opportunity cost is there. So that requires also more deeper thinking about where is the best place to put your dollars.
So, Johnny, you mentioned right at the start of this conversation that the passive versus active investment is a perennial debate in the markets. Who's winning the argument right now? Does the future funds move tip the balance in favour of active managers?
The debate is very much alive and well, and even this year in the US, it's been interesting that the stock market has been driven by Apple and Microsoft, which are big weights in the index. So it's been very difficult to deviate from the index because you would have missed out owning a lot of those two stocks which have propelled the market. So again, it's not an easy decision to move away from passive, and passive is still a very powerful force. I think what the Future Fund has certainly done is added to the intellectual debate, and they've made a very clear statement that the environment is one that will favour active managers. Ironically, while the Future Fund is making this proclamation, the trend towards passive is going the other way for superannuation funds. So superannuation funds are under this new regulation called Your Future, Your Super. And if I had to summarise it, it's basically super funds are being judged against their own benchmarks. So what they've put on the tin effectively to tell their members what they intend to do and the returns they tend to get. And the consequences for, falling short of those benchmarks are quite severe. So a lot of directors of super funds or boards of super funds are quite risk averse in terms of underperforming their own benchmark. So while a lot of active managers might have been encouraged by the message from the super fund, and while there may be a reason to it, the policy winds are blowing the other way and forcing more superannuation funds to consider going passive, ironically. And some would say, if you agree with the Future Fund, they're doing it at the most inopportune time.
So you've got the Future Fund taking this big bet on active managers, but you've got super funds being more cautious so that they meet their benchmarks.
Yeah, so one is a kind of an assessment of the environment, and one is a fallout from policy and regulation.
Very interesting. Johnny, Arndt also said at the Alpha Live conference that war between China and the US was quite possible. Is that geopolitical uncertainty feeding into the volatility that he's talking about that has prompted this move back to active investing?
There's probably two aspects to the geopolitical tension. So absolutely, more geopolitical tension creates uncertainty, and whether you can take a view on whether you think there will be conflict in Taiwan and make bets accordingly, or you could take the view of the Macquarie strategist Victor Schwertz, who believes that the troubles that Russia has had in Ukraine has reduced the possibility of a conflict between China and Taiwan to zero, which might, you might take the other side of a bet that conflict creates areas in the market that you should avoid. What is a big risk, and this is applicable to the Future Fund, the superannuation funds, and possibly pension funds in the United States, is whether that tension between China and the United States makes China or Chinese assets uninvestable from an ESG or governance perspective. And that will create all sorts of complications for big asset owners around the world.
So, Vez, what happens now? The Future Fund has signalled to the market that active is back. How will it play out from here, and what does it mean for the investing industry in Australia?
It's a huge signal because I think some stock pickers have felt a little bit isolated by, the trend towards passive, the super funds consistently squeezing them on fees for many, many years, and then the whole monetary picture as well. So battling so many fires. I mean, this is a big thing. I don't know that it's going to help everyone, but if the Future Fund is on your side, well, you're probably in a good place.
What I would say about the active and passive debate for everyone outside of the Future Fund and the entire industry is it's very emotive, and the reason it's emotive is clear because it's existential. If you believe in passive investing, you don't believe in doing your work, in analysing companies, in turning over rocks, looking at balance sheets, talking to management. A believer in passive doesn't really believe in any of those things, and we're in a world where things are moving and things are breaking. I mean, take a look at Silicon Valley Bank. That was ultimately a bond market story of rapidly high interest rates caused by inflation that infected the venture capital industry, that then infected a listed US bank, that created a huge opportunity for short sellers and huge risks for long-only investors that owned that bank. So that was a clear case in which knowledge of the environment and knowledge of risks and acknowledgement of a sector really made a huge difference for those that had done their homework. And I think Silicon Valley Bank is just the first of many examples of what we will see in a whole range of sectors, from energy to technology to retail. It's going to pay to do your homework, and that homework doesn't extend to understanding the company, but understanding consumers, understanding the environment, understanding the geopolitical backdrop. So we're absolutely in an exciting and interesting world, and that is one that plays into the hands of active managers. And here at the AFR, we kind of feel that we have a role to play in supporting active management, in finding out information and sharing ideas and providing the information at the company level, at the economic level, at the macro level. But we also have to acknowledge the personal finance aspect and the investment aspect of it, that a lot of fund managers don't outperform the market. So we're sort of caught in two camps, but we certainly believe that without active managers, without thought leaders, without thoughtful allocation of capital, the world is not a better place. So we welcome a world where information, skill and knowledge helps translate into actual outperformance.
Thanks, Johnny. Thanks, Vez.
Thanks, Lisa.
Thanks, Lisa.
And the other big story we're covering this week is the federal budget that was handed down on Tuesday. Senior correspondent Jacob Greber was in the lockup in Canberra poring over the budget papers, and he's here to give us his brief take. Jake, give us the main takeouts from the budget and how it's been received.
So we've got a brief return to surplus in the coming financial year that has some people excited. But then, unfortunately, we go back into a long string of deficits. So the pressure remains on the government to address the long-term structural issues in the budget. But more upfront, what we saw this week was a whole bunch of targeted welfare spending, single mothers, older people, low-income households, giving them assistance either through direct payments or for things like energy bills. There'll be energy bill relief with the money going via your retailer. So it's quite a range of things. The overall reaction to it, I would say, is the sort of welfare lobby, the groups calling for more care. They're actually sort of disappointed. They were expecting even more. And then the government's also copping it, I think rightly, from those who say this actually does end up adding to inflation, and that puts upward pressure on interest rates. So Albanese, the Prime Minister, has been talking about how we're caught in the middle of this thing, and that's sort of how the budget's landed in general.
So there were some winners on the night, and one of the biggest and most surprising might end up being mining billionaire Andrew Forrest. Tell us about that.
So Andrew Forrest is really one of the flag bearers for what some people hope will be a vast new industry that replaces some of the earnings we make now as a nation from resources, and that's hydrogen. The government's put aside $2 billion that will be given to the industry in form of a production credit. And that's really an idea that the Biden administration has developed in what's known as the Inflation Reduction Act. And they're doing it on a massive scale. The equivalent, if we were to spend that kind of money in Australia in sort of proportional terms, we'd need about a $50 billion scheme. So that gives you a sense of just how big the Biden one is. And the concern is it's so good that it's sucking all the investment out of Australia and other countries to the US. So the government is really moving, I think, with quite a bit of haste. They recognise the need for speed on this. So yes, Andrew Forrest might be one of the big winners, but there are other big companies like Woodside, Shell, BP that might also get a bit of this action.
So, Jake, now the first real budget for the Albanese government is out there. Where will the political fight be?
So it's already shaping up very quickly. The first one's on the economy. The coalition is attacking the government, saying there's nothing really in this for the broader middle Australia. There's stuff for the sort of lower income strugglers, but there's nothing for middle Australia, which is also feeling the pressure from high interest rates, cost of living, and the pressure on their incomes in a high inflation world. It's taxing everybody in a subtle way. It's sucking your ability to spend in a subtle way. And the coalition's hammering on that issue. And the other thing that they're going to be probably heading towards is really starting to question the government's migration outlook, which is for a really large increase in coming years, over 400,000. And I think that's going to be framed around, can Australia cope with that kind of an influx? Do we have the housing? Do we have the infrastructure? And I think there is community anxiety about that, and the coalition's going to question the social licence for that type of inflow of people. Now, business and a lot of other people, economists, will tell you we need those skilled workers to come into this country so that we can maintain productivity, so that we can maintain living standards. So it's going to be a tricky, potentially difficult and ugly fight.
Thank you for listening to The Fin. I'm Lisa Murray, with Vesna Poljak, Jonathan Shapiro and Jacob Greber reporting today. The Fin is produced by Alex Gow and Lapfan. Fiona Buffini is the executive producer. Our theme is by Alex Gow. If you like the show and want to hear more, follow us wherever you get your podcasts and consider rating and reviewing us as it helps others find us. See you next week.
The Australian Financial Review.